Hey everybody, I'm Mike Desepoli and welcome to the Heritage Market Pulse for Friday, November 12th, 2021. We hope you had a great week. A lot to talk about here to wrap up this week in the markets. We saw a lot of volatility this week, but markets are higher today and trying to squeak out a small gain for the week after the move lower that we saw on Tuesday and Wednesday on the backs of some of the news we're about to discuss here. So first and foremost, over last weekend, we got news that the House had passed a $1 trillion infrastructure package, scaled down from its original stated price tag of $3.2 trillion. But 13 Republicans came together with Democrats to pass this bill out of the House and send it along to the desk of President Biden. So that naturally on the face sounds like it's good news, more stimulus, more spending. But 2 days later on Wednesday, we got our monthly CPI, the Consumer Price Index report, which is the number one readout or measure of inflation. And we saw inflationary gains of 6.2% year over year, which is an astronomically high number if you think about inflation normally running around 2.5% per year, and actually persistently below that for the previous 5 or 6 years here. This number is a little problematic because right on the back of passing another spending package, this gives a lot of pause and concern to people in Congress and the Senate that maybe this additional spending with this new $1 trillion infrastructure bill that's set to pass, this might facilitate more inflation, right? So there is some people now that have concerns about this. It remains to be seen how this bill will be used and where the $1 trillion will go. But naturally, spending more money does not dampen inflation. So I know I've heard a lot of talk about that. The White House has suggested that this bill is needed to tamp down on inflation. And, the facts are when you print more money, you create more inflation. There's really no other way around it. So again, we like infrastructure. We want to see people go back to work, but they need to thread this needle very carefully so that inflation does not become a runaway train. Now, why does the market get spooked about high inflation? Inflation is something that we always deal with, but when it moves too quickly in one direction or another, it will catch the market's attention and sometimes take them by surprise. The concern here is if inflation continues like a runaway train, the Federal Reserve will have only one response to try to combat inflation, and that'll be raising interest rates. Now, we know inflation in different parts of the economy is running at different rates. Some of it certainly has to do with the supply chain. Some of it has to do with massive increases of demand that we've seen as people reemerge outside of their homes from the COVID pandemic. But naturally, this is something we are watching. We don't think the Fed is going to move too quickly to try to raise rates. We think they're going to be very patient. So we don't share the same concerns that the market showed this week. But naturally, that is why we saw a pretty steep sell-off Tuesday and into Wednesday. Relative to inflation, the administration has requested OPEC to increase oil production to try to help with some of the price increases that we've seen at the pump. And flatly, OPEC said no chance. They are not going to increase production. And really, who could blame them, right? They have us right now backed into a corner. We're paying oil prices, really don't have anywhere else to go other than the strategic oil reserves. So that request was declined. So as far as any pressure easing at the pumps, it doesn't look like we're going to get any help from OPEC in that regard. We did see international travel resume this week. International travelers being allowed to enter into the U.S. for the first time since the initial restrictions were put into place. Travelers must be vaccinated, but this is something that should be a boost to the tourism, hotel, and leisure industry, and that obviously is something that we like to see. So here's two very interesting data points that we got this week, and they really fly in the face of one another. So the first thing we got is data on what we call the quit rate. Right? How many people are quitting their jobs? Now, quitting your job may sound like a bad thing, but generally it speaks to financial confidence, right? If people are leaving a job, they're confident they're going to be able to find another one. And we saw the quit rate, or the number of quits for the month of October, 4.47 million. That's the most people that have quit their jobs in a single month in the last 10 years. So it would tell you, generally speaking, that people are confident in their ability to land another job. However, a day later, we got our consumer sentiment reading, which is a measure about people's confidence looking forward in both the economy and their own personal financial situation. And consumer sentiment came in at a 10-year low, reading a 66.8. So anything above 50 still shows confidence. Below 50 would show pessimism, but 66.8 is the lowest reading we've seen in the past 10 years. So a lot of people would say, how can this be? That people are quitting their jobs in record numbers, confident about the ability to find a new job, but yet consumer sentiment is low. So it's going to take a couple months for these numbers to work themselves out to see, is this a trend that persists, or does consumer sentiment bounce back? Perhaps people are a little bit bothered by inflation, supply chain issues, some empty shelves in the store, and naturally that could dent some consumer optimism. So we'll keep an close eye on that, but that's something that you generally don't see, those two indicators divergent to one another. And the last thing I want to mention here is the fear and greed index, right? We spoke about it a lot in September and October, where we were seeing really weak seasonal markets. And a lot can change in a short period of time. So about just a month ago, right, we were seeing the fear and greed index teetering around anywhere from 15 to 20 in that extreme fear level. And here we are today, fear and greed index is at 82, right? So a lot of improvement in investor sentiment in a short period of time. The market has come a long way in a short period of time, so it would be natural for the market to take a pause here, catch its breath, and build up energy for that next move higher. That doesn't mean we have to move down swiftly. Sometimes going sideways for a little while is just as effective in working off some of these overbought conditions. That's all we have here for today. A lot to talk about. We'll try to fit it in a short period of time, give you a look behind the curtain as far as what went on this week in the markets. If you have any questions, please reach out to us. Always happy to talk to you about anything and everything that matters with your money. We hope you have a great Friday and a great weekend, and we will see you back on Monday for the Heritage Market Minute.